The number just hit. 8:30 Eastern, March 6th, 2026, February NFP. The most important data point for silver this entire month. And here's what you need to understand right now before the dust settles and the mainstream tells you what to think about it. The consensus coming into this morning was 60,000 jobs added for February. That is less than half of January's 130,000 print. Gold, silver. The entire silver trade for the next 30 days pivots on whether that number came in above or below that line. And I am going to walk you through exactly what each scenario means for your stack, exactly what the Fed does next, and exactly what the three most likely silver price outcomes look like through the March 18th FOMC meeting. Because here is the thing. This is not just a jobs number. This is the number that determines whether the dollar stays elevated above 99, whether rate cut expectations for July survive or collapse, and whether silver's structural bull market gets a fuel injection or a speed bump. I am not here to panic you. I am not here to hype you. I am here to give you the complete mechanical picture so you can make your own decisions with your eyes open. Let's build it from the ground up. Every number I give you today is public and verifiable. Links to all data in the description. Section 1. What NFP actually does to silver, the mechanical reality. Before we get into the number itself, let me be precise about the transmission mechanism, because a lot of people watch NFP and think they understand its impact on silver. Most do not. NFP does not directly move silver. NFP moves the dollar, and the dollar moves silver. Here's the chain. Strong NFP prints more jobs than expected. Market interprets that as a healthy labor market. A healthy labor market means the Fed has less reason to cut rates. Less rate cuts means higher real yields. Higher real yields mean the dollar stays strong or strengthens further. A stronger dollar makes silver more expensive in every currency outside the United States. Demand pressure drops. Paper price follows. Reverse the chain completely for a weak NFP. Fewer jobs than expected. Labor market softening. Fed has more reason to cut rates sooner. Rate cut expectations rise. Dollar weakens. Silver becomes cheaper globally. Demand pressure rises. Paper price follows upward. A stronger than expected NFP, specifically a gain over 60,000 jobs with earnings growth above 3.7%, would likely reinforce perceptions of labor market resilience. This could further delay Fed rate cuts, especially alongside sticky inflation from energy costs, causing the dollar to rally sharply. Conversely, a weaker than expected report, less than 60,000 jobs, or a jump in the unemployment rate toward 4.5%, could ignite fears of a recession, weaken the dollar, and boost precious metals as both a safe haven and inflation hedge. That is the mechanical picture. Now let me show you what today's specific number means inside that framework. Section 2, the labor market context. Why this NFP carries unusual weight. To understand what today's number means, you need the full context of what the labor market has been doing. Because today's print does not exist in isolation. It is the latest data point in a trend that has been building for months. January 2026 NFP came in at 130,000 jobs. That was well above the Bloomberg consensus estimate of around 55,000 to 65,000. The unemployment rate edged lower to 4.3%. CBS News, on the surface that looked strong. A beat, a relief. But here is what was buried inside that report that most coverage completely missed. The BLS revised its 2025 payroll data dramatically downward. The seasonally adjusted non-farm employment level for March 2025 was revised down by 898,000. Total non-farm payroll growth for all of 2025 was revised to just 181,000 for the entire year. That is an average of 15,000 jobs per month, less than half the previously reported 49,000 per month. CBS News read that again. The BLS quietly told the market that the entire 2025 job market was roughly half as strong as anyone thought at the time. Every decision made by the Fed, by investors, by silver traders throughout 2025 was based on data that was overstated by nearly 1 million jobs. The consensus for today's February print is just 60,000 new jobs, down from a revised 130,000 in January. With the unemployment rate expected to hold steady at 4.3%, the report will serve as a stress test for the Federal Reserve's current pause strategy. The Street. And here is the critical context that makes today unusual. The BLS announced it will introduce population control adjustments with the February 2026 estimates released today. That means today's report carries not just the February headline, but also updated population controls that could shift the unemployment rate independently of actual hiring trends. JM Bullion. 2 layers of data, 1 headline, jobs number, 1 population control adjustment, both hitting simultaneously. That is why today's print is more complex than a normal NFP, and why the initial price reaction may not tell the full story. Section 3, the dollar picture going into the print. Let me establish exactly where the dollar stood before this number dropped, because the starting level matters enormously for understanding how far silver can move in either direction. The dollar index DXY rose sharply on Tuesday, posting a 3.25-month high driven by stronger than expected economic data. The February ADP employment report showed U.S. employers added 63,000 jobs above the 50,000 estimate. The February ISM Services PMI rose to 56.1, the strongest pace of expansion in 3.5 years. Seeking alpha, that double beat on Tuesday is what crushed silver to the $82 range yesterday. 2 consecutive data points saying the U.S. economy is stronger than expected. That forced the dollar up and silver down mechanically. The dollar index DXY enters today's NFP with support at 98.60 and 98.0, and resistance at 99.56 and 100.03. That 100 Mars to 103 level is the ceiling that matters most right now. Multiple institutional FX desks have flagged that area as a zone where dollar bulls face significant overhead resistance. The reason is the Iran war energy shock itself. Higher oil from geopolitical tension is simultaneously bullish for dollar safe haven flows and bearish for the broader U.S. economy. Those two forces cancel each other out at some level, and that level appears to be the 100 area on DXY. What does this mean for silver? It means if today's NFP is strong and the dollar rallies, it runs into a wall near 100. That limits the downside on silver from a dollar-driven sell-off. And if today's NFP is soft and the dollar pulls back from 99, silver has room to recover toward $85 and then $88 to $90 without fighting dollar headwinds. The ceiling on the dollar is the floor on silver's downside. That asymmetry matters right now. Section 4. The 2 scenarios. What each NFP outcome means for your stack. Let me give you both sides precisely. No spin in either direction. Scenario 1. Hot NFP. Above 80,000 jobs printed. Dollar rallies. DXY pushes toward the 99.56 to 100.03 resistance zone. Rate cut expectations for July start eroding below 50% probability. Silver, which has been trading around $82 to $84, gets hit again. If the NFP comes in stronger than expected, the dollar would likely see a sharp rally as rate cut bets are pushed further into the future, with gold and silver facing downward pressure as yields rise. Intraday silver move in this scenario, a $2 to $3 drop from pre-release levels within the first 30 minutes. Key level to watch is $80-50. If silver breaks below $80-50 on a hot NFP print, that is a meaningful technical breakdown, and the next structural support is $78. Why is this scenario possible despite ADP coming in above consensus? Because ADP and NFP have diverged significantly multiple times in this cycle. ADP told you 63,000 Wednesday morning. NFP could tell you a different story entirely this morning. Scenario 2, soft NFP, below 50,000 jobs or unemployment rate ticking up to 4.4% or higher. Dollar reverses. DXY drops back toward 98.50 or lower. Rate cut expectations for July get repriced stronger. The Iran war inflation narrative gets reframed as a growth killer rather than a dollar supporter. Silver uncoils from its compressed range. Silver is currently trading about 30% below its record January high of $121, gaining from both strong industrial demand and investors moving away from the US dollar. Gold silver. A soft NFP removes the primary headwind that has been holding silver below $85 all week. Intraday silver move in this scenario, a $3 to $5 spike within the first hour. Key resistance to watch on the upside is $85, a break above $85 on volume after a soft NFP confirms the dollar pullback is real and $88 to $90 comes back into near-term range quickly. And here's the asymmetry that most people are missing this morning. The downside scenario requires the dollar to break above its 100 resistance ceiling. The upside scenario only requires the dollar to fall back to where it was earlier this week. The path of least resistance for the soft NFP scenario is shorter and cleaner than the path for the hot NFP scenario. Section 5. The Fed is trapped, and that matters more than today's number. Here's the bigger picture that today's NFP number fits inside. Because even if the number comes in hot, the Fed situation does not actually become more comfortable. It becomes more complicated. The February NFP report is more than just a jobs tally. It is a stress test for the Federal Reserve's current pause strategy. The emergence of energy-led inflation, driven by the Iran war, evokes memories of the late 1970s. Historical precedents suggest the Fed is reluctant to cut rates when energy prices are surging for fear of unanchoring inflation expectations, even if the labor market is softening. The street read that carefully. The Fed is not frozen because the economy is strong. The Fed is frozen because inflation from the Iran war energy shock will not cooperate with rate cuts. That is a fundamentally different and more dangerous situation. If today's report comes in significantly weaker than 60,000, the calls for a rate cut to prevent a recession will grow deafening. Yet if wage growth remains high, the Fed may be forced to maintain a higher for longer stance to combat the stagflationary pressure of the energy shock. The street. That is the trap. Weak economy pushing toward cuts. Hot energy inflation pushing against cuts. The Fed sitting exactly in the middle with no clean move available. JP Morgan sees silver prices averaging $81 per ounce in 2026, but notes that if tariff uncertainty revives the trade of moving metal back to New York, physical liquidity outside the U.S. begins to get tight, and you could get into an environment where significant upside opens for prices again. Substack: a Fed that cannot cut because of energy inflation is a Fed that is slowly losing credibility as a tool for managing economic pain. And when central bank credibility deteriorates, the assets that benefit most are the ones that exist outside the banking system entirely. Physical silver, physical gold, real things that cannot be printed. That dynamic does not change based on whether today's NFP prints 40,000 or 100,000. It deepens either way. Section 6. The physical market is not watching this number. I need to separate two completely different silver markets that are running on completely separate tracks right now, because the NFP number moves one of them. It does not touch the other. The paper market in New York is watching NFP right now. Futures traders, options desks, dollar correlation algorithms. Every leveraged position in silver is recalibrating based on what printed at 8:30 this morning. That is the price you see on your screen. The physical market is not watching NFP, not today, not this week. Silver prices surged into 2026, but have since dropped up to 37% due to dollar strength and rising U.S. rate expectations. But the structural 67 million ounce supply deficit persists as EVs, solar, and semiconductors drive industrial demand growth that is unlikely to slow down. Qcoin. The supply deficit did not change because of today's jobs number. The COMEX registered vault sitting at approximately 86 million ounces with 52 million ounces of delivery demand already standing from first notice day did not change because of today's jobs number. The Wells Fargo delivery notices, the Samsung direct mine offtake deals, the Shanghai premium. None of that changed at 8:30 this morning. What changed at 8:30 was the paper narrative for the next 2 weeks. The physical reality for the next 2 years is unchanged. Silver is outpacing gold as a hedging asset due to its dual appeal as both an industrial and investment metal, with Bank of America forecasting silver to reach $135 to $300 per ounce by end 2026, driven by long-term industrial and monetary demand. Qcoin. The paper price is where you buy. The physical reality is why you hold. Do not confuse the two. Today's NFP number is relevant to the first. It is irrelevant to the second. Section 7. What comes after today? 3 macro triggers in 8 days. Here's the timeline that silver holders need to hold in their heads right now. Because today is not the last event this week. It is not even the last event this month. Today, March 6th. February NFP at 8:30 Eastern. The dollar reaction sets the near-term direction for silver. March 12th. February CPI inflation data. This is the number that tells you whether the Iran war energy shock has started feeding through into core inflation. If CPI comes in hot, the higher for longer narrative gets fuel. If CPI surprises soft, rate cut expectations surge. March 18th, Federal Reserve FOMC meeting and rate decision. As of today, the CME FedWatch tool indicates a 98% probability that the FOMC will maintain the target rate at 3.50 to 3.75% at this meeting. The street no cut expected. But the language matters enormously. If Powell signals dovishness in the press conference, silver reacts. If Powell signals higher for longer, silver faces more headwind. 3 separate triggers, 8 trading days, NFP today, CPI next week, Fed the week after. This is one of the most compressed macro sequences of the entire year for silver. The direction that emerges from these 3 events in sequence sets the tone for the entire second quarter. Watch all 3, not just today. Section 8, what to watch right now. Everything is free and public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here on YouTube and on X where data drops when it breaks. Here's your specific watch list for the next 8 days. Silver spot price, key levels. Right now, silver is trading around $82 to $84. Watch $85 as the immediate resistance on a soft NFP reaction. A break above $85 on volume is the first confirmation that dollar headwinds are fading. Watch $80.50 as the structural support floor on a hot NFP. A break below $80.50 means the next level is $78. The DXY in real time. Watch whether the dollar can actually break and hold above 100 on a strong jobs print or whether it stalls at that resistance zone. DXY stalling at 100 limits silver's downside even if the NFP comes in hot. CME FedWatch tool, free at the CME website. Watch the July 2026 rate cut probability in real time as it reprices after the NFP print. If July cut odds drop below 40%, that is a dollar bullish signal. If July odds stay above 60%, that is a silver bullish signal. January NFP revision. Buried inside today's February report is a revised number for January. The consensus expected 60,000 jobs for February, with some major banks like Wells Fargo forecasting as low as 45,000. Gold, silver. But the revision to January's 130,000 print is equally important. A downward revision to January combined with a soft February is a double negative for the dollar and a double positive for silver. Watch both numbers simultaneously when the release drops. COMEX registered silver inventory, updated daily at the CME website. Whatever happens in the paper price today, the registered vault number tells you the physical reality. If that number drops below 80 million ounces this week, while the paper price reacts to NFP, you have a picture of two markets moving in completely opposite directions. That divergence does not last forever. Section 9. The honest conclusion. Here's the full picture as of this morning, March 6, 2026. February NFP dropped at 8:30 Eastern today. Consensus expectation was 60,000 jobs. January printed 130,000. Wells Fargo forecast as low as 45,000 for February. Gold silver DXY at a 3.25-month high coming into today's print, driven by Tuesday's ADP beat of 63,000 and ISM Services PMI at 56.1, the strongest in 3.5 years, seeking alpha dollar resistance zone at 100.0 to 100.03. That ceiling limits the downside for silver even in the hot NFP scenario. Fed rate cut odds for the March 18th FOMC meeting, sitting at 98% probability of no change. Rate cut fully priced in for July at approximately 50 to 60% probability. The Street 2 scenarios. Hot NFP above 80,000, dollar rallies, silver tests 80-50 support, soft NFP below 50,000 or unemployment rate rising, dollar reverses, silver breaks $85 and eyes $88 to $90. Physical silver market completely disconnected from this paper event. Structural 67 million ounce supply deficit running for the sixth consecutive year. Bank of America's $135 to $309 forecast based on supply deficit and ratio mechanics that do not change based on any single NFP print. Qcoin 3 macro triggers in 8 days. NFP today. CPI March 12th. Fed March 18th. The sequence of these three events sets the direction for the entire second quarter of 2026 for silver. Today's number moved the paper price. The physical reality did not move. Your job is to understand both tracks simultaneously and not let a $2 to $3 move in either direction convince you that the structural story changed. It did not. Watch the DXY. Watch the key levels. Pull the CME FedWatch tool. The data will tell the story in real time. Invest with logic, not hype. Protect your capital. The chart tells you price. The data tells you direction. Drop NFP result in the comments with the number you saw print at 8:30 this morning. Let's track it together.